This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Wealth and Toil. My name is Luke Laretive and I'm here today with the usual suspect that I get stuck with once a week, Dylan Pargiter-Green. DPG, how are you, mate?
I'm really good, mate. The usual suspect. I think that's one of your worst and one of your best at the same time for an intro, mate.
As I said before, I'm not very creative. I'm trying my best to come up with something every week.
I appreciate you.
What's
news, mate? What's going on?
Mate, I am flat out like a lizard drinking, so I am going to
trades.
bang out.
Few trades.
Busy. I've got a few things going on. So I want to get through this podcast episode with you and get back to work. So
Hey, to everyone that's listening, Luke really cares about you and really cares about doing this thing that we do on a weekly basis.
This unpaid community service I do on a weekly basis.
I think that he really cares about me as well.
I really don't. As usual, I care about my bank balance and my business. That's what I really care about.
You are a one track mind, one trick pony, my friend.
I definitely am that, mate. Today we're going to talk a little bit about SMSFs and buying property in SMSFs, and a little bit about super and retiring with an SMSF. So it's going to be the DPG show today.
The DPG show.
Can I maybe just kick it off? The most common question I get asked about SMSFs, and my only comment about them, well, two things, is one, how much money do you need to realistically run one? And I would say $500,000 in combined super is probably the answer. It's going to cost you $2,000 or $3,000 a year for an audit. It's going to cost you another $1,000, $2,000 for a tax return. For that entity, so let's call it three to 5,000 just in fees, and that's before you pay someone to manage it if you're not going to do it yourself. So
100%.
That's kind of my 1% in other admin fees, and you're going to pay someone like me 1% to help you with it. Well, that's 2%. That's about all you'd want to be paying in fees in totality, in my view. That being said, the other thing I would like to point out before we go full deal mode is that I don't really see the point of having an SMSF if you just want to buy shares, bonds, liquid assets, things that trade around the world, managed funds. Because from my perspective, whether it's Premium, what we use, whether it's another platform, all of the sort of wrap and managed investment scheme platforms that are available these days, unlike the 90s, now have access to direct shares that you can buy and sell on there, direct international shares, extensive lists of managed funds, all on the approved product list, giving you exposure to almost every asset class that you could possibly need. So from an individual's perspective, if you just want control of your investments and you want to have some input on your asset allocation and some transparency on your portfolio inside super, you do not need to have an SMSF to achieve that. So they're my two SMSF messages for the day. And Dill, you can get into the nitty-gritty.
Man, hit the nail on the head with the balance. I think the most common time when people come to us and say, can I set up an SMSF, is when they go, okay, well, my balance is 100, 150 grand, or perhaps, one partner has a much bigger balance than the other, and they think that, if we combine it, there'll be then 300,000 in there, and then we can use that as a deposit for a $1 million house, and that'll be great because then we'll have $1 million property that we couldn't be able to get otherwise.
Yep.
That's the most common time when
unless if you are going to run a micro cap strategy where you're going to be taking placements and buying small companies, yes, you need an SMSF probably to be able to do that properly. If you're going to run a direct bond strategy where you're going to actually source direct from issuers, yes, you probably need to have an SMSF to run that strategy. And if you're going to invest in obscure wholesale only managed funds,
who's doing this?
Look, I'm just saying that people do it, and so yes, you may need an SMSF to do that. I think the only real common thing that happens in SMSFs that you actually need one for is if you want to buy direct property, and you want to own a property or properties. Now, let's talk a little about diversification and the practicalities of buying property in SMSF. Let's talk about loans and access to debt. Let's talk about diversification and balance size and how much you would actually need to make it all work from a practical perspective.
Let's step through it a little bit, because I think what you were saying before about the fact that most platforms, most modern platforms like wrap platforms, what we use as advisors to manage people's investments, will have access to most of the things that people in the 90s and 2000s and even the 2010s would have wanted to have an SMSF for. So you want to have a direct share portfolio, cool. You can do that, and you can do all your own admin and audit and all that sort of stuff. Or you can just pay a platform 35 basis points and it's done.
Even less. 35 if you've got a small balance of like 250. Realistically, if you've got a balance of 3 mil, it's $3,000 a year max. So
it's not much. So that's one thing. The other thing is that within an SMSF structure, you wouldn't go and put all of your money into one stock in a wrap platform, and if you had a share portfolio, you wouldn't go and put all your money into one asset or one asset class necessarily. So the concept of putting all of your eggs into the property basket really needs to be questioned there. And again, it is the most common thing that people want to do. I want to own property in my self-managed super fund. This can be a wonderful strategy, but it's so important that we look at what the long-term outcome of holding that property is and what the goals of holding that property is. Because we need to make sure that you're meeting the requirements of superannuation throughout the entire lifetime. So first off, when we're looking at buying property, my general recommendation is that we use only a portion of the balance of the superannuation fund in order to use to buy that property, in the same way that if you've got 500 grand, you don't put $500,000 into a property and have it at 50% leverage. You generally put your 20% deposit and use the tax effectiveness of the debt. In the same way, the debt within the superannuation fund is also its investment debt. It's claimable. There's tax and income that's coming in there. So use that as effective as it is. But that also allows you then to invest the remaining of your balance into more traditional, a balanced or a growth allocated investment portfolio. It gives you diversification.
Hey, Dill, but look, in your experience, do most properties ungeared, do the returns actually stack up? Because, I would argue that on an ungeared adjusted basis, you'd have to be buying a pretty savvy resi property to make it stack up against a MSCI All World ETF or a decent managed fund. Like from in my experience, you're looking at sort of low single digit annualized returns on the gross value of the property, which, if you're 5 times geared or 4 times geared like you are normally on a resi house, but it
makes sense.
It makes sense. But
also
in super, you get no, like, you're not getting a capital gains tax. It's not your own home, so you don't get that kicker at the end on the tax side.
You do get a capital gains discount, though.
Of course you do, but you get a capital gains discount on everything. It doesn't matter what you buy.
But it's even better in super. So there's an argument there for that. The thing that you're missing there, I think, with the property, and particularly resi property if it's ungeared, is that you get the complete advantage of the yield on the property as well. So because you're not funding debt, you're not only reliant on capital growth, you're also getting a yield which tends to increase over the journey.
Yeah, well, I suppose what I'm saying though is that, okay, let's pretend I've got $3 million in super, right? Fairly wealthy person in the context of, the big bad world. We're going to go out and buy an apartment. Let's just say $750,000 apartment, right? Decent size apartment or a small house somewhere in a median. There's a median. What's the median Melbourne house price now? Like $800,000 or something.
820, 840.
Okay, 828. Let's just pretend you're buying a median house. It's the worst house in the best street, and you're the savviest property person in Australia, and you're able to go out there and identify this and buy it cheap and whatever. Yeah. Even then, you've put 30%, let's just call it for round numbers, 28% of your capital into one house in one street in one suburb, and it's not really it's probably paying you only.
It's probably
3.5% yield.
3.5% yield. And
before you pay agents, before you pay property manager, before you pay maintenance, land tax,
rates.
Yeah. So look, I'm not saying no property. People can do whatever they like. I don't care what people do with their money. But it to me, if you can make it work in a super environment, and you can show me that it stacks up, because I can show you 15 ways that it doesn't.
Yeah, and that's right. And so look, there are tax advantages. The capital gain tax advantage is there. That generally the capital gains tax, if you hold an asset for more than 12 months, is only 10% within superannuation. So of course, if you do have a lot of capital growth on that property, that's wonderful. But I think, like what you're saying, right? Leverage is what creates the significant growth in property most of the time. Significant growth,
and the fact you don't pay tax on your own home.
And, the fact that you don't pay tax on your own home, but of course, there's plenty of people out there that have paid tax on investment property, capital gains, holding assets. You get a discounted gain for holding it for an extended period of time, and you only pay 22% tax on that gain as well, which is very good. That's outside super. We're talking about
inside super, you get
SMSFs.
15, half of that, 7. Yeah, okay, makes sense.
Yeah. So it still makes sense. But I think that the other thing that people a lot of the time don't realise is that leverage within a self-managed super fund is costing you 7 to 8%.
That was actually my next question. I was like, I haven't looked, but you tell me what's my cost of capital in inside SMSF.
So investment properties at the moment, generally we're getting, you might get 6.5% as your rate. That's already costing you, upwards of $1,200 a month on a $500,000 or $600,000 property, just in maintenance. So your contributions are actually then being eaten up by interest cost, because above and beyond what the rent is.
Yeah, and can I deal the other thing that we're going to touch on this, and this is kind of what made us talk about this particular topic today. But okay, let's ignore the good advice and not advice, but asterisk advice from Dill and I, saying, look, really have a think about it, do the numbers, make sure it is going to stack up for you based on your assumptions, regardless of how incorrect I think those assumptions are. The reality is,
classic
do whatever you want.
Stockbroker.
Do whatever you want. Do whatever you want with your money. However, Dill, when you get to the later stages of retirement, the 75 plus bracket, what do you do? Because if I'm 80 and I need to rip out 6-7% out of my super, well, I'll just sell 6 or 7% of my share portfolio, and I can do that at fair prices, and I only need to sell 6 or 7% of the holding, and I can realise that and rip it out of super and spend it, or whack it in my non-super account. So what do you do if you've got a property, and particularly if it's geared?
I think this is a big issue. I would highly discourage those people from having gearing at that stage of their lives as well, like owning a property with gearing in self-managed service. Something's gone wrong at that point. And
what does happen though? If I'm in pension phase, and I'm let's just say I'm 80, and I've got a property that's worth now, say $1.5 million because I am a genius, right? And I've doubled my money over 10 years. But I still owe 400,000 on it or whatever. And I've been using that for tax advantage in super and blah, blah, blah. And I fall off the perch and hit, the ticker gives up. What actually what happens?
Well, I mean, you lose your tax advantage of holding an SMSF if you fail to pay out the amount that you need to.
Your required withdrawal every year.
That's right. Percentage. So as you get older, once you start an account-based pension that is a 0% tax environment for all your earnings, which is a wonderful thing to have, and arguably when you've got market-based investments that are regularly compounding, you're probably theoretically better off in that environment with market-based investments than property. But it's not to say it's not a good asset. But if you fail to pay that out, you lose your tax benefits. You lose that 0% tax environment. And so, I mean, like, not being able to pay that out effectively means that you either have to sell your property or re-gear it to be able to pay that back out. Now, if you're 80 years old or 75 years old, you don't really want to be going to the bank and saying, hey, I've got this property in my self-managed super fund and I can't pay myself because there's not enough liquid assets in there anymore. So then your options are either cop the tax, move it back to accumulation, and then it doesn't have the 0% tax environment anymore, and so you've lost the benefit of it.
Not a good idea.
Yeah. Or, I mean,
you got to sell it.
Or selling it. Now, good example right now, a lot of people are saying, I'd rather not sell my property because it's not a very good market. Well, that's like any asset except...
That's a tough titties bucket.
That's a tough titties bucket. And then what are you going to do? You're going to buy another property, you're going to do that. So, look, that is largely, we're talking about residential property and why it is a lot more challenging in superannuation, I think, than other people. I think that it is generally talked about. I think one of the other things that is a major consideration is that commercial property can be a incredibly good long-term hold for business owners who want to hold, who rent a premises like a warehouse or a factory or an office, because office rent, factory rent, warehouse rent, very, very expensive. And that is a known cost. You're in control of your own lease. You know that you're going to be able to pay that, and you are better off paying, a 9% yield to yourself, even if that's leveraged, and owning the property, than you are paying that 9% yield with rental increases and everything.
I love the like if you've got a business that needs a premise, and even I looked at it for Senec. JB and I almost bought an office during COVID, but for Seneca, but we've just decided we're going to go office light and continue the way we've been continuing. But look, I think owning your premises in your super, if you're a business owner, is pretty lovely, and it's got there's a lot of practical day-to-day advantages, and then there's a bunch of financial things that I think are worthwhile. I also just love business owners taking care of their super properly, because it is a neglected thing from business owners because we don't pay ourselves properly. So I like that. You're kind of forced to put money into super because you're servicing the debt. It kind of makes sense from that respect. But yeah, look, like that for a lot of business owners. It doesn't suit everyone. Not everyone's got the cash flow to do it. It's not for everybody. But as a general comment, it works pretty well often.
It works from a financial perspective and from an asset perspective a lot of the time, because particularly if you do use leverage, and you can combine superannuation monies with business partners and things like that. You don't have to combine all your super either. So you can each contribute $100,000 from each of your superannuation funds, put that in, then buy your $1 million premise with a 70% loan, and then the business is funding the rent on a property that you all own equal shares on. And then if and when the business decides to move out or you sell the property, you all get equal shares back from that as well. You at the same time can then have your other money, where you put your regular contributions, accumulating in shares that are completely separated from your business partner super as well. And you're not paying any more money to do that other than having the self-managed super fund. But the reason I like it is not so much the financial, or not 100% the financial, it's the control that it gives you. As a business owner, you're then not subject to someone coming and knocking on your door 6 months out from the end of your lease and saying your rent's going up by 30%.
Or you got to move.
Or you got to
move your premise. Like it, that's a pain. If you're a big, big factory or warehouse,
if you're a big factory, warehouse, these sorts of things, the cost of moving, the cost of reinstalling, all that sort of stuff, that can be tens, that can be even hundreds of thousands of dollars.
Like commercial's so different to resi. Look, I think if you want to have a conversation about buying a premise for your business, give Dill a buzz and seek advice. Get in touch with him, and we can start to have a look at it. Because it is really, it can be very effective. Dill, for just flipping back to the average SMSF, and I would say there's a generation of people who are probably now between 50 and 70 who, have there's a lot of SMSFs in that cohort. I don't think there'll be as many in maybe our age group in our mid to late 30s. And I, because of the lack of technology that was available when they wanted to do this stuff, and accountants were really pushing it for a while there. So I just wonder, winding up an SMSF now, if people wanted to do it, how do they go about it? What do they do? And we did one for one of my clients not that long ago.
It's pretty easy. Yeah.
And so what's involved for people?
What's interesting, right? Like self-managed super funds are just super funds. So effectively, you're rolling the assets out to another fund. If you want to move,
you don't have to sell. You don't no capital gain. You can just do an in specie.
No, it's a rollover, right? So if you want to, you can transfer, provided it's staying within the same structure. So within a superannuation trustee structure, it doesn't have to be the same trustee. You can in specie between. So if you've got $1 million in CBA shares and you're worried about the big capital gain because you've held them for 30 years, you don't need to worry about that really, because you're in specing it. The second thing is you might be in pension phase, and actually holding $1 million in one stock's not a good idea, even though you've done well out of it. But it's not a difficult thing to do. The big change here, and like the example that we were talking about earlier, you've got to be aware of what the next 10 years holds. So, for people in accumulation, late stage, where they've built most of their superannuation, they have that property, you've got to understand what the goal of having that property is in superannuation beyond perhaps your life expectancy. And I think that one of the things that often gets missed is that people go, I want to have this property as a legacy asset. I want my kids to inherit it. I want this. Well, depending on the way that it's set up, like, inheritance for an illiquid asset may end up, if it was pre-tax money that was put in, so taxable component of the superannuation, you might be giving people an asset upon death that has a 17% tax payable on the value. They're probably going to need to sell that property to pay that tax.
Yeah.
So, like having that conversation early, understanding that a legacy asset is a legacy asset. You don't want to pass on a tax burden. You want to actually think about what you're doing with that property and have those conversations early. Perhaps bring that property out of super if you hold it in there, so that way, your requirement to draw down is less. There's a whole number of things. You do have to consider stamp duty. You have to consider transfer fees, all those sorts of things as well. So it's quite complicated. And again, this is one of the reasons that we say to people, holding a property in self-managed super fund is not I'm going to buy a cheap property and see it triple in value over the next 10 years. And it's all hunky-dory because that's what property does. It's a lot more complicated than that.
Can I be really cynical for a minute?
Yeah, sure. Unusually cynical?
Unusual for me. The reality is as I said, there's a generation of people with a bunch of SMSF, and there's a bunch of spruikers out there who promote property inside SMSF as for a range of reasons. I think primarily they are for their own benefit and not for the end user's benefit. and that is because they charge you $5,000 to set an SMSF up. They charge you $2 or $3,000 a year to audit it, $2,000 for the tax return, and then maybe to manage the investments that are in it for you, or you buy some property, single asset property MIS, and then they're charging an origination fee for the buy. They're charging a management fee per annum. They've got working capital costs built into the running of the business that you're invested in, or the units that the trust that you're invested in, and then they're going to charge you some sort of performance or disposal fee on sale of that property when it goes through eventually, and hopefully you make some money at the end of it if you manage to get out of it at all. So from my perspective, I think the punters should be really careful with people promoting property-based investment schemes utilizing SMSF. It is not for the faint-hearted, and it's certainly not for those people who aren't unusually or exceptionally financially literate. And if you aren't sure, there's a real good bloke down in Tasmania you can ring with a mustache, and he will help you wade through and show you the alternatives, the things you can do where you don't need to lock your capital up, where you don't need to hope that some land subdivision development gets approved by the council, where you don't have to rely on somebody else necessarily to generate really solid returns for yourself and your family, and still leave a really good legacy for them. So, personally, I'm a big believer in just, KISS principles, keep it simple, and you can do just fine. And from my perspective, I can tell you right now, I'll never buy a property in SMSF.
No,
unless it's an office for Seneca, that'll be the only time I would consider it. And like you said, probably do it with a business partner or three, and in a pretty controlled and small way.
And I think there are wonderful stories of success, and I think that
mate, I can tell you a few wonderful stories of success. People buying shares in a company and doing absolutely nothing, and I can give you. There's no problems with it when it goes right. No problems there. No one's worried, right?
That's it's almost my exact point, right? So there are some wonderful stories of success, and there are some really great uses of property and self-managed super fund. I guess the point of this episode is that, at this point, we are looking at what our clients' pension requirements are in the year. So July is the time when we look at everyone's, okay, this is how much you've got to draw down. And if a red flag comes up with clients that do hold these things, a lot of our business owner clients do have properties in the self-managed super fund, we need to be prepared. And unfortunately, we probably see too many people who are unprepared for these sorts of things. The one other thing that I would note, and it's just a little caveat before maybe we wrap up on this, is whilst we talk about commercial property being a good asset, having high yields and things, the thing that people often forget is that commercial assets can go unrented for extended periods of time. And if your rent at the point of needing to draw down or funding your debt throughout the accumulation phase is what is required to make sure that you can satisfy that loan and not have to sell in a stressed way, be very, very careful and have enough liquidity and have the diversification, because we don't want people ending up in a position where their warehouse that they've bought, because it's a good commercial asset with good yield, is out of tenants for 12 months and then they just have to sell it untenanted and it's not worth it what they bought it for.
I was going to say, and the risk of that is
just the risk
you probably bought it tenanted. I mean, I'm not a commercial property expert, but if you buy a property tenanted, generally it's going to trade on a lower yield than if you bought it untenanted. And as a result, if you're selling untenanted, you're going to be selling on a higher yield, or that's code word for lower price. So just, keep that in mind. Dill's making a very good point there. Mate, this has actually been an interesting topic. I like this. This is good. I actually like this. This is good. This is actually practical stuff that is interesting, unlike our usual podcast episodes.
I asked Luke if he'd done his homework before this podcast, and he said, no, I'm not reading about that.
That's not what I said. No. I was being busy. But I didn't do my homework, but it turns out I actually do know something.
You knew more than I thought you would, which I should give you more credit. But no, I mean, these sorts of things. These are these are the crucial questions for people that we see every day, you and I. Whether it's property or, having a self-managed super fund just to run a share portfolio, the effect of the decisions that you make on your fees on admin, whether or not you hold a property, the risks that you're taking, that's all we're talking about here is risk.
Yeah, so, and I mean, that's all. I mean, people get probably more emotional, and there's probably more social kudos for being able to say, I own a property, than there is to say I own a share portfolio. There just seems to be one's tangible and seems to be, given kudos and credits in society, and one doesn't. From my perspective, that is not relevant, but that's not everyone's point of view. And certainly, I like to just look at things on sort of an empirical level and look at the data and try and figure out what the right thing to do is with the available information. Doesn't mean it's always right, but certainly we want to use, the available information at the time, make the best decision we can. So, people think that I've got an aversion to property, or I'm against it or whatever. I'm not. I'm not against anything. What I am for is looking at every available investment opportunity that I can get and trying to create the best possible risk-adjusted return for myself as possible. And I think if you're not looking at your investments like that, you're probably going to make a mistake. So that's
Don't fall in love with something just because it makes you feel good. Fall in love with
correct.
it.
I'd rather be rich. I'd rather be rich and feel bad about it.
Or feel good by being rich because you've made the right decisions on an objective basis.
As someone smart once said to me, don't worry about looking rich, worry about being rich.
Yeah. That's good.
I can't remember, some smart ass stockbroker I know.
I like that.
That's a good quick episode, and I like it. I've got to keep moving because I do have a few things to do.
Pump it out. You got trades to make. Busy.
I appreciate your time as always and knowledge. You've been very good today, which is unusual. But
mate, we got next week, Equity Mates Live. You and me.
Is that next week?
That's next week.
Okay, quick plug for Equity Mates Live. I don't even know if there's any tickets left. If you want a ticket and you don't have one, email me and I'll find some way to sneak you in a back door with entourage of 40 people. So
they're going on Tixel for $500 a pop, I think. Secondhand ticket.
Okay, so is 17th of July?
No, it's the 10th next week.
Sorry, there you go. That's how well I'm going. 10th of July in
Wednesday
Melbourne.
the 10th.
It's at the pub that got renovated on the corner of Exhibition and Little Collins. Morris Place,
Comedy
Morris
Club
House.
Comedy Club basement or whatever
it's
called.
In the basement of the Comedy Club. Dill's doing an Ask an Advisor segment where you can ask, questions about, should I save money? Answer yes. Should I invest
you buy
in
property
super?
in your SMSF?
What's better, property or shares? Whatever Luke says, that kind of thing. and then I'm doing live Pimp My Portfolio, where I'm actually reviewing Bryce and Alex's portfolio from Equity Mates. So that should be good fun. So if you want to get along, get a ticket. If there's no tickets, email me.
Love it. Thanks very much, mate. Have a great rest
See you
of
next
the day.
week.
Bye.
Bye.